If you're jumping from one strategy to another and still not consistent, that's the problem. You don't need 10 strategies. You need one simple setup that actually works. In this video, I'll show you a powerful one-candle pattern, the smart money trap pattern that can change the way you enter trades. No indicators, no confusion, just clarity. Before we get started, here's exactly what you'll learn. The one pattern smart money uses to trap traders. The hidden variations most traders miss. Where it works best and why most people get it wrong. How to trade it on any time frame. And how to spot trades in just 10 minutes a day. By the end, you'll be able to use this strategy with confidence without confusion. Alright, let's dive in. Now let me show you how this pattern actually works. The smart money trap pattern is built on just one candlestick formation, but it happens in 3 steps. First, you have what we call the mother bar. This is a strong candle that sets the range. Then, the second candle forms inside it. This is the baby candle. Because it stays within the high and low of the mother bar, it creates a range-bound market. Now this is where things get interesting. The third candle is the most important one. This is the trap candle. If price breaks below the range, and then closes back inside it, this is a bullish, smart money trap pattern. It means sellers got trapped, and buyers are about to take control. On the other hand, if price breaks above the range, and then closes back inside, this becomes a bearish smart money trap pattern. Now buyers are trapped, and sellers are ready to push the market down. Now let me show you a real chart example. This is the US dollar and Canadian dollar on the 5-minute chart, and as you can see, the market is in a clear uptrend. Buyers are in control, so our goal is simple. We're only looking for buying opportunities. Now focus here. We have an inside bar pattern. This is the mother bar, and this is the baby candle inside it, creating a small range. Now watch what happens next. The market breaks below the mother bar, making it look like price is about to go down. But instead of continuing lower, it quickly closes back inside the range. This right here is the smart money trap pattern. Sellers got trapped, thinking the market would drop. But look at what happens next. Price reverses, pushes up, and continues moving higher with momentum. Now look at another chart example. This is the 5-minute chart. And as you can see, the market is in a clear downtrend. Sellers are in control, so the best trading opportunities here are sell setups. Now focus on this area. We have an inside bar pattern. This is the mother bar, and this is the baby candle inside it forming a range. Now watch carefully what happens next. The third candle breaks above the range, making it look like the market wants to go higher. But instead of continuing up, it quickly closes back inside the range. This is a smart money trap pattern. Buyers got trapped, thinking the market would reverse. But in reality, sellers were just collecting liquidity before pushing price lower. And look at what happens next. The market drops and continues moving down as expected. Now, you might be asking, why is this considered a smart money pattern? Because this setup actually reflects a complete smart money cycle. Let me explain. The first candle, the mother bar, defines a range. The high acts as resistance and the low acts as support. Then, the second candle, the baby candle, shows price moving inside that range. This phase represents accumulation or distribution, where smart money is quietly building positions while retail traders are uncertain. Now comes the key moment. The third candle, the trap candle, represents the manipulation phase. This is where smart money pushes prices outside the range, triggering breakout traders and hitting stop losses. But instead of continuing, price snaps back inside. That's the trap. And what comes after that is the most important part. The real move. This is where smart money drives the market in the true direction. And this is the move you want to ride. Now, is this enough to trade the market? The answer is no. If you trade this pattern blindly, you will lose money. That's why it's important to watch the entire video. Because I'm going to show you exactly when to use this setup, and more importantly, when to avoid it. Because this is where most traders get it wrong. When trading this setup, you'll notice that it doesn't always look the same. It comes in different variations and you need to understand each one. The first type is the classic smart money trap, an inside bar followed by a pin bar. This signals a false breakout and a strong rejection. The second type is a more complex version, an inside bar with the mother candle, followed by multiple baby candles, and then a pin bar. This shows consolidation before the trap is triggered. And the third type is a range-based setup. You'll see a series of candles forming a range, then a breakout candle, followed by an opposite candle that closes back inside the range. This is a clear sign of a liquidity trap. So when you're trading this setup, don't expect it to look identical every time. Recognizing these variations is what allows you to stay aligned with smart money and avoid getting trapped like most traders. Smart money doesn't use this pattern randomly. There are 6 key institutional areas where this candle appears. To trap retail traders, trigger their stop losses, and move price in the opposite direction. And if you don't know these areas, you'll be the one getting trapped. So keep watching, because I'm going to break down each area step by step so you know exactly where this setup works best. Now let's talk about the first institutional area. This is the buy-side liquidity zone. Buy-side liquidity represents a pool of buy orders resting above the current price. In retail trading, this usually comes from stop-loss orders placed above swing highs, resistance levels, equal highs, or obvious technical ceilings. Now look at this chart. As you can see, the market was trending up, then it hits this level and forms a resistance. Most traders now expect a breakout, so they place buy orders above the resistance, expecting price to continue higher. This area is what we call buy-side liquidity. Now watch what happens next. The market retraces and comes back to this key level. Then it breaks above it, making traders believe the breakout is real. But right after that, it forms a smart money trap pattern. First, you have the mother candle, followed by multiple smaller baby candles, showing consolidation. Then price breaks above the range, trapping breakout buyers, and finally, a strong bearish candle closes back below the level. This is a clear smart money trap, a false breakout designed to take liquidity before the real move begins. And look at what happens next. The market reverses and moves down as expected. Now let's move to the second institutional area. This is the sell-side liquidity zone. Sell-side liquidity is the pool of sell orders resting below the current price. In practical terms, it forms below swing lows, support levels, equal lows, or obvious downside levels, where traders place their stop losses. Now look at this chart. As you can see, the market is in a clear downtrend. Sellers are in control. Price comes down, hits this level, and forms a support. Now, most traders expect the market to break this support and continue lower. So they place sell orders below the level, and their stop losses above it. This area becomes a sell-side liquidity zone. But now, watch what happens next. The market breaks below the support, making it look like a continuation. Then we get an inside bar pattern, the mother bar, followed by the baby candle, and then the trap. Price fails to continue lower, and forms the smart money trap pattern. This means sellers got trapped, right at sell-side liquidity. And when this happens, this setup becomes even more powerful. Look at what happens next. The market reverses and moves up to the target as expected. Now let's move to the third institutional area. But before that, make sure you keep watching, because once we finish covering these institutional areas, I'm going to show you exactly how to trade this pattern step by step. So you don't just understand it, you'll know precisely how to use it in the market. Now let's move to the third institutional area. This is what we call a supply zone. So what is a supply zone? A supply zone is an area where institutions have previously sold the market, creating strong selling pressure that pushes price down. Now here's the key idea. When the market comes back to that same area, it becomes another high probability opportunity to sell. Why? Because there are still unfilled institutional sell orders waiting at that level. And it's also a zone that is widely watched by traders around the world. Now look at this chart. You can see the market dropped strongly from this area. This is our supply zone. Then price retraces, comes back to the zone, and this is where things get interesting. We get an inside bar pattern, followed by the smart money trap pattern. This shows that buyers are getting trapped, right at a level where institutions are looking to sell. And look at what happens next. The market gets rejected and continues moving down as expected. Now let's move to the fourth institutional area. This is the demand zone. A demand zone is an area where institutions have previously bought the market, creating strong bullish momentum. You can usually spot it by looking for strong, impulsive green candles moving away from a level. This is not retail activity. This is institutional buying pressure. Now here's the key idea. When the market comes back to retest that same area, it often gets rejected and moves up again. Why? Because there are still pending buy orders in that zone, and many traders are also watching it, expecting a reaction. Now when you combine this with the smart money trap pattern, it becomes even more powerful. Because instead of buying randomly, you're entering exactly where institutions are active. Now look at this chart example. As you can see, this is a clear demand zone. The market moved up strongly from this area, which tells us that institutions were buying here. Now watch what happens next. Price retraces and comes back to this key level. Then we start to see rejection signals. We have a pin bar here and another pin bar here, which could already offer entry opportunities. But the strongest signal appears right here. A clear, smart money trap. We have the mother candle, followed by two smaller baby candles forming inside its range, showing consolidation. Then price breaks below the mother bar's range, but quickly closes back inside it. This is one of the strongest setups you can find. A classic liquidity trap. And as you can see, right after that, the market moves up exactly as expected. Now, there's one important problem we need to solve when talking about supply and demand. Not all supply and demand zones are equal. And this is exactly where most traders make mistakes. They mark every zone and expect the market to react. But the truth is, a valid supply or demand zone must follow specific criteria. Because if the zone is weak, even the best pattern won't work. So before you use the smart money trap pattern, you need to make sure the zone itself is strong and valid. Let me show you exactly what to look for. First, look at the momentum. When institutions enter the market, they leave a footprint. You'll see strong, explosive moves with clean, directional candles. That kind of move tells you there's real money behind it. But if price moves slowly, with hesitation, long wicks, and no clear direction, that's not institutional activity. That's noise. And you want to stay away from it. Second, focus on fresh zones. The best zones are the ones that haven't been touched yet. Why? Because the orders that created the move are still sitting there. So when price comes back for the first time, there's a higher chance of a strong reaction. But once a zone gets tested again and again, it starts losing its power. At that point, it becomes much less reliable. Third, pay attention to market structure. The strongest zones usually appear after the market breaks a key level. This could be a previous high or a previous low. That break is important. It shows that the market has shifted, and smart money is taking control. When a zone forms after that kind of move, it carries much more weight. And finally, think in terms of risk and reward. A good setup is not just about being right. It's about how much you win compared to how much you risk. You should always aim for at least a 3-to-1 reward to risk ratio. If the trade doesn't offer that, it's not a high-quality opportunity. Stay with me, because in the next part, I'll show you the exact entry, stop loss, and target using this pattern, and this is where most traders get it wrong. Now let's move to the fifth institutional area. This is what we call the accumulation phase. When the market is trending down, sellers are in control, but at some point, they start taking profits. And when that happens, the market stops dropping and begins to move sideways. This is what we call accumulation. During this phase, smart money is quietly buying positions, preparing for the next move up. Now here's the key moment. Before the market moves higher, Smart money creates what we call a spring. This is a false move below support, designed to trigger sellers and hit stop losses. But instead of continuing down, price quickly returns back inside the range. This is the final trap before the real move begins. And when your smart money trap pattern appears at this point, it becomes a high probability setup, because you're not just entering a trade, you're entering at the beginning of a new uptrend. Now look at this chart example. As you can see, the market was in a clear downtrend. Sellers were dominating the market. Then price stops dropping and starts moving sideways. This is the accumulation phase. It means sellers are taking profits, while buyers are quietly building positions. Now here's the important part. Sometimes the market breaks out of accumulation, and sometimes it continues going down. So how do we know the difference? The answer is the spring. Now watch what happens next. The market forms what we call a mother candle, followed by a smaller baby candle, the inside bar, showing consolidation. Then price breaks below the range, but quickly closes back inside it. After that, another candle sweeps liquidity below the support level, forming what we call a smart money trap setup. This is also known as a spring, and it signals the end of the accumulation phase and the potential beginning of a new uptrend. As you can see, the market moved up exactly as expected. Now let's move to the last institutional area. This is the distribution phase, which is simply the opposite of accumulation. Here, the market was trending down, and then it entered an accumulation phase. A spring formed at this level, signaling a potential reversal, and the market started moving up. It continued pushing higher as buyers took control, but at some point, smart money begins to take profits, preparing for the next phase. And when that happens, the market stops going up and begins to move sideways. This range is what we call distribution. During this phase, smart money is slowly selling their positions, preparing for a move down. Now here's the key moment. Before the market drops, smart money creates what we call an upthrust. This is a false move above resistance, designed to trap buyers and trigger breakout entries. But instead of continuing higher, the market reverses. In this case, the upthrust forms as a smart money trap. You can see the mother candle, followed by a smaller baby candle, showing consolidation. Then the third candle breaks above the mother bar and above the distribution resistance level, but quickly closes back inside the mother bar and within the distribution range. This is a strong signal that smart money is entering the market and that a new downtrend is likely to begin. Now you know how to identify the smart money trap setup, the different variations it can take, the psychology behind it, and where it works best. You've seen that this pattern is most effective when it forms under key institutional market conditions, at buy-side and sell-side liquidity zones, at supply and demand levels, during accumulation phases, during distribution phases. Now, let me show you how to actually trade the market using this smart money trap pattern in these conditions. This is the British pound and Japanese yen on the 1-hour chart. As you can see, the market hits this level and reverses, forming a support level. This level represents sell-side liquidity because traders place their stop-loss orders below it, expecting the market to break it next time. At the same time, others place buy orders, anticipating a move upward. Now look at what happens next. Price retraces back to this level, and as it reaches it, a smart money trap pattern forms. First, we have the mother candle, followed by 3 smaller baby candles, showing consolidation. Then the final candle breaks below the support level, sweeping the sell-side liquidity and quickly closes back above it. This is a clear liquidity sweep created by a smart money trap, giving us a strong buy signal. Now, let's move to the higher time frame to confirm the setup. On the daily chart, the market is clearly trending upward. Price has already broken above a key resistance level, which suggests that the bullish momentum is likely to continue. Now let's go back to the 1-hour chart to execute the trade. Entry: at the close of the candle that created the false breakout. Stop loss: below the liquidity sweep. Target: the next key level. And as you can see, the market moved exactly as expected and reached the target. Now let's look at another chart example. This is the British pound and Japanese yen on the 1-minute chart. As you can see, the market hits this level and reverses, forming a support level. This level represents sell-side liquidity. Price then retraces back to this level, and as it approaches it, a smart money trap pattern forms. First, we have the mother candle. Then, a smaller baby candle forms inside its range. And finally, the third candle breaks below the mother bar and the support level, sweeps the sell-side liquidity, and then closes back above the level and inside the mother bar range. This is a high-probability smart money trap buy signal. Now let's move to the higher time frame to confirm the setup. We switch to the 15-minute chart to check if the higher time frame aligns with our 1-minute trade. As you can see, the market is clearly trending upward, which supports our buy setup on the lower time frame. Now let's go back to the 1-minute chart to execute the trade. Entry: at the close of the candle that swept liquidity and closed back inside the mother bar range. Stop loss: below the liquidity sweep. Target: the next supply zone above. And as you can see, the market moved exactly as expected and reached the target. Now, what if you don't have time to trade? What if I told you that you can trade the market using just 10 to 15 minutes a day by focusing on the daily time frame with this strategy? Look at this chart example. This is the Australian dollar, US dollar on the daily chart, and as you can see, the market is ranging. Price hits this level and reverses, then retraces back, hits the level again, and reverses once more. Then it comes back for a third time, and this is where the opportunity appears. A smart money trap pattern forms. So if you're short on time, all you need to do is check the market once a day right at the close of the New York session. This allows you to see the final daily candle. And in this case, that last candle is the third candle of the smart money trap. The first candle is the mother bar. The second candle is the inside baby candle. And the third candle breaks above the mother bar and above the resistance level, sweeps buy-side liquidity, and then closes back inside the range. This is a clear buy-side liquidity trap. In just a few minutes, you can identify this setup, place your entry, set your stop loss above the sweep, and target the next key level. Then you simply let the trade play out. And as you can see, the market moved exactly as expected and reached the target. So as you can see, this simple candlestick setup, when combined with institutional areas, can provide high-quality trading opportunities across different time frames. If you enjoyed this video and found it valuable, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next lessons. And if you want to take your trading to the next level, check out the link in the description for more in-depth strategies. Thanks for watching, and I'll see you in the next video.